So for about the last 20 years, Richard Golod was the director of global investment strategies for firms including Invesco Funds, Van Kampen Funds, and Morgan Stanley Asset Management. He came back to our firm about 5 years ago to manage a very specific equity strategy for Morgan Stanley financial advisors and their clients. Rick is known for his bold calls and a way of taking complex investment concepts and explaining them in terms all of us can understand. He is one of the few financial strategists invited by the Pentagon to share his economic outlook to a select group of military leaders and the Department of Defense analysts. Born in Africa, raised in Europe and Asia, Rick brings a unique set of skills and hard work analyzing the financial markets and trends every day. He is a graduate of Washington University in St. Louis with a degree in finance and concentration in investments. At Morgan Stanley and our investment management partners, I have access to hundreds of the best minds in the business. I can count on one hand those I follow, trust, and I believe get it right. Rick is one of those special people. I value him as a friend and a key resource for the benefit of my clients. I encourage you to listen carefully to Rick today. The equity class rotation strategy he created and manages has outperformed the S&P 500 year to date over the last year, over the last 3 years, and over the last 5 years. That is very impressive. Please welcome Rick Golod.
Thanks, Brad. Thank you. Appreciate it.
You need the handheld? Or you can
No, I've got a wireless mic. Good afternoon. I appreciate that intro. The warm-up, so I'll find somebody else, but good shot. So how has the Delta variant changed our lives? For me, it's great to see people in 3 dimensions instead of 2. So I'm sure a lot of you have done the Zoom calls. I'm wearing pants today instead of gym shorts, so that's new for me. That changed my world a little bit. Maybe it did you as well. We got to the point, at least at our firm, where when somebody said, "Do you want to do a Zoom call?" we just kind of went, "No, we don't want to do any more Zoom." So we kind of got zoomed out. I think we're all ready to get out of hibernation and start doing things. We certainly see that when I follow open table reservations and people that are searching for flights. We're seeing that turn, but we've seen that 3 or 4 times. So let's make sure we are all on the same page as far as what happened pre-pandemic, where we were, and where I think we're going. And more than happy to share take some questions. And as Doug said, I spend every waking hour of my day reading research, working my mathematical models to figure out where I think people have the highest probability of making the most money with the least amount of risk. And I spent 20 years identifying the factors that drive asset class and sector outperformance. And there aren't a lot of people that have that area of expertise, but it really takes that kind of commitment to time because there's just a lot of moving parts. So pre-pandemic, we were faced with deflation. We had a massive stimulus package, which was unusual from the prior administration. It was unusual because normally you don't get fiscal stimulus, government spending, until the economy is in a recession. We got stimulus when the economy was doing pretty good. And it just turbocharged economic growth. And then the pandemic hit, and that was more of a depression. And we can debate whether it was the appropriate response by the government and the Fed, but I saw depression, and they just shot a big bazooka to make sure that they solved that problem, and they nipped it in the bud very quickly. But it caused some imbalances, clearly. I mean, you had companies that were operating, they'd already liquidated their inventories. In fact, I don't know if any of you were able to take advantage. When Hertz was selling their fleet, I have a neighbor that bought a 2020 740 BMW, 3,000 miles on it, still had the plastics on the back seat for like $50,000 because they were just They were just dumping, get rid of inventory, raise cash, get rid of all extraneous people, get down to a skeleton crew. And then what did the government do? They wrote a check that for a lot of people was twice their income. It was massive. It was equivalent to here's an economy growing at 2% a year. This check was equivalent to like 12% GDP immediately. There's just no way companies could ramp up fast enough to meet that demand. I call it the cabbage patch syndrome. If you think about, for those of us that had kids way back, this was this Christmas item that everybody had to have. And boy, the price of this doll just went into the hundreds. So you have this mismatch that we're still dealing with. And so what do you hear on the airwaves, and every time you read is, oh my goodness, we've got this hyperinflation situation. And they talk about the 1970s. And I can tell you right now, this is not 1970s. 1970s, you had heavy union membership. Everybody had cost of living increases built into their wage structure, especially if you worked for the government. Union membership is at a 50-year low right now. It's coming back, but there's not a lot of people who have a salary plus the inflation rate. And if you look at what's happening now with wages, real wage growth, so that's wages minus inflation, it's negative 2.7%. So how do you keep spending on money that you don't have? So the inflation rate, you already know the number. My wife quoted me, and she doesn't even quoted the news. CPI, headline inflation, 6.2%, the highest in 31 years. It's interesting they used year over year as opposed to month over month. It's interesting that they used a metric that the Fed doesn't follow. The Fed doesn't look at CPI to dictate their changes in interest rates. They look at something called PCE, the personal consumption expenditures. And that's not at 6.2%, that's at 4.4%, but that's year over year. What is it month over month? That's what I want to know. Is it getting worse or getting better? Actually, month over month PCE is down 6 consecutive months in a row. It's falling. In other words, the rate of growth or the rate of inflation has already turned to the downside. And you might say, well, that's not happening. Well, just take a look at the Citigroup the inflation surprise index. They look at that. Is inflation surprising people's expectations or coming in below? It's also rolling over and falling. If I look at the sectors in the stock market that should be outperforming if inflation is growing, in fact, I heard somebody from Merrill Lynch's COO of their private trust department make a statement that logically made all the sense in the world. He said, if you're worried about inflation, buy the companies that have pricing power, that can pass on those increased costs. If you've done that the last 2 months, you've lost money, you have a negative return. What's that telling you? It's telling me the market is already past the inflation scare, or those stocks would be going up. They went up the first 7 months of the year, and now they're falling. In other words, they're taking their profits. I don't know. I'm not convinced that things have peaked, but here's my issue. Let's talk about the wages that you're seeing. Well, we can't find workers. So what's interesting about inflation is if you look at the countries that had the greatest stimulus, they have the highest inflation rate. Direct correlation. So if you dumped a lot of money on people very quickly, you've got an inflation problem. The other is the pandemic. That's creating supply chain disruptions, yes? And you've got people who are saying, I'm not going back to work because of COVID. So let's look at Canada, our neighbors. They have a 75% fully vaccinated society. We're at 57%. Their workers, it's called the labor participation rate, already back to pre-pandemic highs. In other words, you remove the fear, I'm going back to work. What's going on here? Our labor participation rate, well, we're still looking for 7 million workers. We don't know where they are. They're not going to work. They haven't retired. They're just in limbo right now. And we know who they are, too. It's predominantly women who they got let go because they dominate the service industries. They are caring for kids or a loved one and don't feel safe going back to work yet. And so that's 2.4 million workers right there. So I see a couple of problems. One, we caused the inflation problem because of the big checks. Two, we've got to fix these supply chains, which are going to take a while. Yes, we have some wage growth, but it's not universal. I mean, it's great to tell me that wages were up 4.2%, but let's look at it by demographic. If you are female, high school educated only, unskilled, working in the leisure and hospitality industries, your wages are going up over 10%. If you have a 4-year degree, and you're 24 to 55, your wages are going up 3%. If you're over 55, your wages are going up 2%. It's not everybody's getting those wage groups unless you're in the leisure hospitality area. So why do they have that advantage right now? Part of it might be immigration, because a lot of, if you brought in immigrants, a lot of them could do those jobs. And right now, there's kind of a hold on that, so there's a shortage. But we believe, again, or I believe, and it gets right back to, it's not the problem in Canada. Why is it a problem here? And it has everything to do with, I don't feel safe. So if you think about, I don't know if you saw the statistic, what percentage of the US Americans have said that they will not get vaccinated? Second highest in the world at 26%. The only country higher is Russia. Great. That's our partner. That's who we share that not getting vaccinated, which does what? It just delays the economic recovery, keeps the supply chains broken for longer, and the longer they stay broken, the higher the inflationary pressures are. So I'm not in the camp that's worried about hyperinflation for a couple reasons. Energy, everybody, well, gas prices. Energy is not inflationary. It's mean reverting. It causes substitution. I'll give you the example. I mentioned it a couple years ago, and I'm not picking on the construction industry. It's just that when I had some work done on a house up in Annapolis, the foreman mentioned to me that his crew, they live paycheck to paycheck every week. He pays them on Friday, and by Thursday night, they're broke. They don't save a nickel. So I thought about that for a second. I went, okay, so what dictates their life? Every penny increase at the gas pump takes $1.5 billion out of consumers' pockets in a year's time. 1 penny, 1.5. So what happens when they have to put an extra $50 or $100 in their truck? So they were taking the family out every Friday night to Outback. Are they doing it every Friday night now? No, it's every other Friday. Or it's another restaurant at a lower price. Or if it was somebody of greater financial means, maybe you're buying a lower priced bottle of wine, or maybe you're not eating it at Ruth Chris. You're saying, let's try that other restaurant that's a little cheaper. But the point being is, it causes substitution. It's not inflationary because energy is not as powerful of a component of our spending components it was in the 1970s. It was 10% of our spending in the 70s. It's 3% today. If we wanted to get the same price of oil that became problematic in the 1970s, the barrel, it'd have to be $120 a barrel. We're not there yet. We're at 80. And that's also somewhat mean reverting, because what happens when the price goes up? We work with a client who owns hundreds of wells in the West Virginia, Pennsylvania area. And he's going, I've got a lot of wells that are unproductive below $70 a barrel, but now that it's above 70, it's flip the switch, it's all in. So you're gonna get this massive supply. Is it gonna happen today? No. This is the winter, this is the demand, so you've got the seasonal influence of higher energy prices, and yes, it will affect our spending, but it's not something that's sustainable to think that, okay, it's 5% this year and inflation will be 6% next year. And so, no, it's going to be a blip and then it comes back down because it's mean reverting unless wages can keep up. And the people who are saying they're not going back to work until they get certain things, it's interesting, demand for robotics is up 68% over the last 12 months. They're going to go back to work and find that their job is gone. Technology solves that problem. And that's been the biggest change, I think, that the pandemic has done. It has accelerated and changed business models. What was the old business model? You build it overseas, you put it on a boat, you get it at a dock, a truck picks it up, you take it to the warehouse, and then from the warehouse, you hub and spoke it into your other distribution areas. That's too disruptive now. How many of you have heard of micro manufacturing? The way of the future. Now with 3D printing, you can just build what you need and you're going to have these you might have 50 plants in various states and it's direct to the consumer. And it's going to create a lot of jobs and a lot of opportunities because that's the future. Distribution. You've already know that Amazon loses money in the last mile. Companies are figuring that out, how to solve that equation. And you're seeing it with driverless vehicles. Now there are driverless taxi cabs, 4-person driverless taxi cabs. And now we've got cars that can fly. That company just went public at $6.8 billion. So that's coming in the future. Solar energy technology is the cheapest it's been. So alternative fuels is part of the future, isn't it? It's going to take time. We're still going to use fossil fuels for a while, but we'll wean ourselves off of that. But there's no investment going in that space, so I still like it as an investment because if you had limited supply and you still have demand that's over and above what's being produced, then you can make money. It's profitable. What else is happening from the pandemic? I think we are a little more aware climate-wise, environmental-wise. Are you familiar with the jewelry store Pandora? No longer buying, well, they're only producing man-made diamonds now that they produce in the lab because they want to get away from the negative connotations of labor and sweat labor, blood diamonds. You've heard of that phrase before. So that's a change. That's new. But yeah, the inflationary pressures, inflation needs a couple of things. You need wage growth growing faster than the inflation rate for people to be able to continue to spend on higher prices. Food's the same situation. If meat goes up too much, what do you buy? You buy something else. You buy chicken, you buy shrimp, or you go tofu, or you do some of the plant-based proteins. And then the price comes down. Same thing with the oil. They just produce more. So it's more short-term. It is transitory. And the Fed believes that it's transitory. Because the Fed's raising rates doesn't solve the supply chain, does it? If the Fed raises interest rates, that doesn't get more product off the container ships that are outside of Long Beach ports. Anybody checked container prices? Are the prices rising or falling? Chuck Todd said they were going up. His information's a little dated. To rent a 40-foot container, that price has already fallen 30% from its peak. It's already rolling over. And yet you wouldn't know that by listening to the news because the news has us all spun up. Oh boy, we got inflation and it is hot. It is hot right now in certain areas. Certain prices are falling. Well, like what? Well, lumber's down 68% prices. That's come back down. Industrial metals are down double digit. So there are things that are falling. So yes, I do think it's transitory. But it still becomes problematic. It affects the market. So why aren't interest rates higher if there was more of an inflation problem? It's interesting when we had that announcement last week, interest rates actually fell. And see, that's why it's so hard, I think, for you and I, listening to the news, to come away with conclusions that are accurate. I call it flawed logic because our minds find patterns even when none exist. We know that from science. And that's why there's this whole field called behavioral finance right now that tries to get us to recognize how we think so that we make fewer mistakes. So, for instance, what would I call flawed logic? In September of 2019, the ISM Manufacturing Index broke 50. And that's kind of a dividing line between whether the economy is expanding or contracting. It hit 48.2. And the news out of the Wall Street was on the news programs is, oh boy, the economy is contracting. It's raising the risk of of a recession, and you should start thinking about being more conservatively invested in things that are defensive. In fact, you should consider raising cash. Made all sense logically, right? Economic slowdown, risk of a recession rising, you should be defensively positioned. The message that I sent out to about 4,000 advisors at Morgan was the ISM manufacturing index is at 48.2. That puts it in the bottom 20th percentile. Historically, when it's in the bottom 20th percentile, stocks trade higher the following 6 months, 83% of the time, and the average return is plus 13%. Buy. And what did it do? It went up 18%. That's flawed logic. Oh, that makes sense. A lot of these things are counter buy signals or counter sell signals. So if you're wondering about the economy, it's pretty straightforward. Economy is driven by four forces, right? Government spending, corporate spending, consumer spending, overseas demand. We just finished 2 years of econ undergrad right there. Is the government going to spend more money or less money? We know they're spending more. But what's interesting about government spending, 85% of government spending is state and local governments. How's their balance sheets look right now with property taxes, retail sales taxes? I mean, their coffers are just growing. When would you spend that if you wanted to get reelected? Would you spend it now or maybe wait 4 or 5 or 6 months till next year? So the question is the government going to spend more money or less money? They're going to spend more money. So they're going to contribute more to GDP growth. How about corporations? Corporations spend money based on profitability. Are they more profitable now than they were a year ago? Yeah. Yeah, my neighbor came down from Jersey. He goes, do you believe the stock market? I don't understand what's going on. It's going up all the time. You don't understand that earnings are up 40%. And the analysts only thought earnings would be up 19%. Oh, and they were up 50% year over year in the second quarter. And they only thought earnings would be up 16. So what does the market do when expectations are below reality? It goes up. It's not voodoo. It's just, wow, I got really surprised. I was expecting so much worse. It came in so much better. So corporations spend based on profitability. So CapEx spending is going to improve, especially now that we're not fully vaccinated, but it's less bad. When things are less bad, you got to believe some of these companies that have been sitting on these projects, these expansionary programs, are going to start releasing those funds and investing. So that's a good contributor. Fourth is exports. Exports is going to be a function of the rest of the world growing. How would you know whether they're growing or contracting? You'd look at the global or the international PMI manufacturing indexes over there to see if they're above 50 and see if they're growing. And you get this, what we call this diffusion index, which just tells you, are more countries growing above expectations or below? And what we find is, wow, 85% of them are now growing. That's good. So if they grow more, we should be able to sell more goods to our neighbors with a couple of caveats. If the dollar's too strong, that prices us out of some of these markets. It makes it more difficult, gives the advantage to countries that have weaker currencies. But for the most part, I expect exports to be a wash. Government spending increases, corporate spending increases, but now we get back to the consumer. Spend what you make, spend what you have in the bank, you can borrow. It's the only three ways consumers can spend. If you think about companies, I can pay you more money, I can work you longer hours, I can hire more workers. So it's pretty easy to figure out, are the consumers going to spend more or less? What's interesting about the checks that they got from the government, they saved a third, they paid down debt with the other third, and they spent a third. Their balance sheets, consumer balance sheets, look pretty good. And that's what they're actually, the people who have not gone back to jobs that they didn't like, they're still spending the money that they got from the government. And that'll just kind of that'll run itself down to the point where you have to ask them, well, most likely they'll go back to work. It is kind of interesting that maybe you're probably reading and hearing about maybe the culture has changed. I mean, for 20 years, workers had very, very little say-so in what they were paid and how they were treated. And now we're starting to think that maybe there's a paradigm shift where workers are gaining more power, and it's a little early to say. We'll see. I just know that a lot of businesses are going to come back to the U.S. This innovation using big data, AI, which is artificial intelligence, deep learning in computers, the change in distribution is creating a lot of opportunities, a lot of jobs where, yeah, I actually could see wage growth continuing. And the good news is deflation has been licked. I'm not in the camp that says inflation is just going to be hyperinflation. I think it goes higher before it goes lower. But it's not something that's going to derail the market. It will impact what works in the market if you like to invest in stocks, and it'll impact interest rates. I suspect interest rates will drift higher, mainly because the current interest rate environment does not match up with what we're likely to see from Fed monetary policy over the next couple of years. So the Fed, the Fed was injecting liquidity in the marketplace, which is important. And this is where a lot of people have missed the stock market the last couple of years. They were looking at economic data and finding all the problems that you and I see. And they didn't realize the stock market was 90% correlated to the Fed's balance sheet and only 7% correlated to GDP. So if you were looking at economic data to drive your decisions, you were looking at the wrong thing. The Fed's balance sheet is doubled in the last year. And you know that they've announced tapering, which just means that they've been injecting $110 billion a month into the economy, month after month and month. And now they're saying, well, we're going to cut that back. But it wasn't because of inflation. It was because they were fighting behind the scenes to keep interest rates on money market funds positive. Very little known facility called the overnight reverse repo market. It's just a depository for banks when they have too much money. There's a place to park it at the Fed. It was a facility that was started in 2014. They haven't used it at all until March of this year. They were depositing about $100 billion overnight. You know what it is today? $1.5 trillion. And that puts downward pressure on rates. And the Fed finally said, we've got too much liquidity sloshing around. We really need to start taking some chips off the table. That being said, they're still going to inject another $480 billion in the marketplace. So is that market positive or market negative? Well, if the market's 90% correlated to the Fed's balance sheet and it's going to continue to expand, that's market positive. And that's why in our industry we say don't fight the Fed. And it's so easy to get caught up in these other extraneous things. No, don't fight the Fed. You know what kills bull markets? Only one thing. It's the Fed raising rates. That's what you and I need to worry about if you have investments in stocks and bonds, but particularly in equities. That's the only thing that kills a bull market. And some people, well, they're going to do it next summer. Really? Is it normal for the Fed to make changes 30, 90 days before an election? They usually go radio silent. That would be very unusual. And if you were the current president looking at your approval rating, would you want somebody raising interest rates right before the election? That doesn't get you reelected. Not that he's up for it, but your party reelected. So what do? You've got somebody going, gee, do you want a second term as the Fed governor? You say you have that conversation with Powell? Yeah, I'd love to have that. Okay, so how do you feel about, could you wait until after the election, maybe December? Would it be that big of a deal? Okay, I can wait till December. And they're going to be able to appoint 3 more governors to help in those votes. So what are they going to be, hawkish or dovish? Are they going to say to Biden, you know what, I'd really like to get that open spot because I want to raise rates to the moon so that you guys lose across the board? It's not likely to happen. It's becoming more political. I'm not saying it's right or wrong, it just is. So I could see a Fed that just stays dormant all through 2022. And the street, Wall Street can make their guesses and make their predictions. They don't pull the trigger. It's like, I don't know if you've heard this term, the five-year inflation break-even rate. Boy, it's at a 30-year high. And the 10-year, all I want to know is it predictive of actual inflation? Well, no, it's not. Then why are we talking about it? And that's the problem on the news I hear on television is that a lot of that information, let's talk about CPI. The Fed doesn't look at CPI. And then the break-even rates are not predictive. And money supply, well, that's inflationary. That came up in our conversation last night. M2 is money supply and money in circulation. It was growing at 24%. That's got to be inflationary. Well, no, it doesn't, because there's another component to that equation called velocity of money. And what was happening is money supply was growing at 25% and people were just putting it in the bank and the bank wasn't lending. So money supply was up 27%, velocity was down 27%. So what was the net? Nothing. It was zero. That's why we didn't have inflation from 2008 to 2017. That's why Japan didn't have inflation. And they poured all kinds of cash for 20 years. And their interest rates have been negative the whole time because there was no demand for money. Companies already locked in long-term debt at very low rates, so their demand for credit isn't that great. And consumers are deleveraging. And aging demographics would suggest less borrowing as opposed to more borrowing, wouldn't it? So yes, there's a lot of money in circulation, so why is that important? Because liquidity trumps fundamentals. It rewards risk-taking and momentum investing, and left unchecked, it builds bubbles. And we're close in almost every asset class. And bubbles never end well. So I think about that momentum investing. Think about what the government tried to do in this pandemic. It's actually pretty logical. They went to the Fed and the Fed said basically to all of you that the only thing that kills a bull market's raising rates. Wink, wink. I'm not going to raise rates for 2 years, which was code for us in the room. Take risk. And just to get your attention, if you didn't take risk and you put it in cash, I'm going to spank you by giving you a negative real return. That cash after inflation is going to be negative. So there was your carrot and stick. And then the government, so for the people who didn't own stocks, what did the government do? They wrote you a check. Here you go. To do what? If my stock portfolio is up, I spend more money. If the government sends me a check, I spend more money, and that's how you continue to grow. Pretty logical. The offset, though, is the supply chain that I talked about. And that's going to be with us for a while. And I don't have an answer for that. But I think I know what's going to happen in the market. Just from a historical standpoint, here's what you should know. We're in a cyclical and secular bull market. What's that mean? Secular bull markets last 17 to 20 years. And we're 13 years into that cycle. And then cyclical bull markets last about 4.5. When both of them are in a bull phase, equity returns are above average historically. That means you should average better than 10% a year. We're a year and a half in the cyclical bull. The markets usually go up 158% on average, and up so far from the bottom, we're up 100. That would suggest we have another 58% upside, but I would submit to you that when you have a greater than average market decline, it's not unusual to have a better than average market recovery. So I think we're going to see something greater than 158% on the way up. And if you think about, well, what drives stocks, it's driven by earnings, valuations, the interest rate, what we call the risk-free rate, and something called the risk premium, which is what do you expect to make over and above a non-risk investment. It's called the equity risk premium. All you want to know is it high or is it low? Because it always seats its average. And right now it's high. Well, of course, because there's a lot of uncertainty out there. You can see that by looking at the Economic Policy Uncertainty Index. You can get that every month. They'll even download it for you. When that is elevated, when we are less worried about, so what might we worry about right now that's keeping stock valuations lower? Well, we got a debt ceiling we haven't dealt with that comes up in December, right? Yeah, you get that behind you, and then that's one less thing to worry about. Before it was, well, we don't know about the infrastructure. Well, I took care of that. What did the market do? Went up because you just reduced the risk. The fear came down. The multiple went up. Earnings are still running at a pretty good clip because analysts aren't getting any guidance from CEOs or CFOs. They're not telling you any valuable information on where earnings are going to be. So if you're going to guess, you're going to guess on the low side. So what happens when you announce your earnings and you beat estimates? Your stock goes up. It's pretty straightforward. But boy, are we getting good at it too. I don't know, here, technology again, things that are making a difference. Big data. So in my portfolio that I run, I have a machine learning algorithm that uses 19 factors, 7 different categories. It's got a 20-year history, 240-month moving averages. And all this does is take those 19 factors and comes up with every combination and looks at what that monthly return would have been for 20 years and says, boy, if you use these 3, then you will be able to predict whether large beats small, growth beats value, and here's your probability outcome for the next 90 days. That's what a machine learning algorithm does. Now, analysts on Wall Street are taking these machine learning algorithms and they're predicting earnings as best they can. Morgan Stanley, Merrill Lynch, Goldman Sachs, we use software that can detect deception when a CEO and CFO are speaking. Because we know if you're deceiving us, maybe, and how's the stock do after that? Usually does pretty poorly. We now know that if we just count the words of their transcripts, we can tell whether they're lying or not. Because think about it intuitively. The longer you know when you're lying, you kind of over talk it. So a group out of Israel has a word search, certain words to pick. They take the transcript, they count the words in a certain fashion, and it's predictive. It is statistically significant in predicting where earnings are going to go. That's where big data is making the difference. When, what was the Mexican place that had the food issues, starts with this, Chipotle's. First thing we did, put drones up in the air, and we just started counting cars at Panera. Where'd they go? Where'd those people go? And then you bought the stock, and of course their earnings went up. Same thing we do with counting cell phones in automobile plants in South Korea to see how many workers are there. And if you have more workers, you probably have more demand because you're producing more stuff. So we're using, so cell phone tracking is a pretty big deal too. So there's some exciting things in the markets. I think there's, usually when you have a good year like we had this year, the average return 12 months later was 11%. One of the things that I talked about internally, because again, things you hear on TV, false logic. I remember in September, the market hadn't had a 5% correction all year. Probably going to get it. That was fear. Boy, be careful. And my message was, we haven't had a 5% correction since January through August. Whenever that's happened in the past, markets trade positively September, December, 100% of the time. All the time. Get in if you're not. Don't wait. What do you buy? And I'm really worried about a lot of things. Let's get into high quality things and conservative things and defensive things. You just lost money. This has been a risk-on rally because that's what liquidity does. It rewards risk-taking. And I don't hope I'm not just rambling here, but I just want you to realize this business. I was the chief global strategist for 20 years, and it doesn't get any easier. There's so much information that really, to be good at it, I think you have to figure out what to ignore. There's just too much noise out there. It's really that part of it. But I think you're going to find a good market. Small caps should have a nice run. Seasonally, they outperform in the fourth quarter. They outperform from November to February. So I do like small caps. Value should be outperforming. That's COVID will have a lot to do with. If we get the cyclical recovery, value stocks will outperform. I'll tell you a little known secret that could help you make more money in your own portfolio, and it's a good thing to just keep in mind when you're working with your advisor. When value stocks in the U.S. beat growth stocks, Europe outperforms the U.S. and vice versa. So if you've heard for 10 years now, go overseas, and all it's done is underperformed significantly. Well, that's what value's done. It's underperformed for 20 years. And now it's the cheapest it's been since 2004 relative to growth. It's trading at a 35% discount. So when value outperforms, Europe outperforms. I can tell you why over time. Here's the other thing you guys don't have pencil and paper handy, do you? Some of you do. I'm going to end on this because this is, a lot of you can do it. Some do it better than others. But this is the strategy that I employ that's outperforming 99.2% of all U.S. tactical mutual fund managers and ETF managers since inception. So for the last 5 years, I'm beating 99% of everybody. And the foundation of it is this. Draw a 4-square box and put large cap value in the upper left quadrant, or just LV for those of you that like Louis Vuitton. Right? So LV upper left, LG upper right for large growth. Lower right, small growth. Lower left, small value. Asset class outperformance has moved clockwise between those 4 quadrants 80% of the time for the last 42 years. It's only 9 years it didn't work. When large value is the best performing asset class, large growth is the next best performer, then it goes small growth, and then it goes small value, back to large value. Stays there 1 to 5 years. So there's a pattern of outperformance. There's a pattern of underperformance. Whatever quadrant's the best, the diagonal's the worst at the same time. When large growth is best, small value is the worst, and vice versa. Large value is the best, small growth is the worst, vice versa. And that's worked 100% of the time in the last 12 years. It's worked all the time. So if you're putting a portfolio together and you're not a trader, you're not whipping in and out of things, you're going to have a diversified portfolio. Let's put more money in the things that are working 80% of the time and less money in the things that underperform 100% of the time. Does that make sense? It's just harder to figure it out. But boy, has it been great. The difference between best and worst just in the last 5 years, 120%. It's significant. It can make a material difference in your wealth. And it works overseas too. But I've used up my time. It is important to know the things I said are not necessarily the views of the firm. Forgot to bring that at the beginning. I definitely have, and that's where again I'm all about probability outcomes. I don't make decisions that don't have outcomes better than 80%. It helps me from eliminating or keeping away from flawed logic. So our chief investment strategist was on TV talking about how he was expecting a 15 to 20% decline in the marketplace. And I knew what he was looking at. And people were saying, well, Rick, what's your opinion? I said, I don't see that. Well, why not? Well, when the economy expands, markets trade positive 87% of the time. And our economy is expanding. Market corrections greater than 10% happen less than 4% of the time. Why would I make a market call that only happens 4% of the time? That's like trying to win an inside straight at Vegas. It's not high enough. I want to make decisions that happen 80% of the time, 90% of the time. So when someone is sharing things with you, instead of getting, the way you eliminate false logic is just ask, what's the probability outcome of that?
Again, thanks for your time and your presentation. It's fascinating. Wonder if you could do a deeper dive in in the discussion of national deficit, and also you piqued my interest when you talked about asset class bubbles. If you could talk a little bit more about that. Thanks.
Yeah, so we have a debt level that will rob this country of future growth. It's called the Ricardian equivalence, and when you get above 220% of debt to GDP, you're financing that debt. It's money that could be used to grow. So it in essence keeps our economy from overheating. You know, what's interesting is, if you ask me, do I think the economy slows next year? My answer is yes, but that actually gets us back into like Goldilocks category. We're not going to grow too fast, which is going to require the Fed to preempt that, and we're not going to grow too slow. We have to worry about a recession. And then it's just going to be earnings driven. Your second question was asset class bubbles. Yeah, they don't end well. And I suspect that this bubble, when it bursts, will be worse than what we experienced from the pandemic. Valuations are at peak levels. And there's only really one valuation metric that is predictive, and it's called the Shiller PE or the CAPE PE. It's a 10-year earnings into the price. It is predictive of 10-year returns, not 1, 2, 3, 4, or 5, but 10 years. And it's higher now than it was during the tech bubble in 2000. So what triggers it? My guess would be the Fed raising rates. That's when I'll be most worried of a change in the way money moves at the speed of light. See, that's the problem investing today. I mean, the returns come so quickly. You're getting annual returns in a month. You know, you used to be able to just build your positions. Wow, this looks pretty good. I'll nibble at it. I'll nibble at it. No, let's say energy's up 50% this year, 40 that came the first 15 days of of its move, and the rest has just been kind of a little bit. So yeah, the asset bubble. So to me, that's 2024. That fits the 4-year cycle of we usually get a major correction every 4 years. Think 2000, 2004 was the past, 2008 was ugly, 2012 happened 2011, fourth quarter down 20. 16, we had 20% down the first quarter. 2020, ugly. And that's why I'm most known for calling most of those. So I had a national conference call at Morgan Stanley April 2000, predicting NASDAQ would fall 40%. I missed the bottom in 02 by 5 days. January of 08, another national call at Morgan Stanley recommending that they move their clients to a 50% cash position. Missed the bottom in 09 by 10%. I was 30% cash October of 18 before the market fell 20%. And last year I got a major sell signal February 20th. I was 45% in cash 8 days later. So I didn't have that downslope because I think the best way to make money or build wealth is not to lose it. It's a crazy concept, but it works. But yeah, it'll get delayed, but at some point you have to pay for the excesses that have been out there. And you see it everywhere. You see it in cryptocurrencies, right? Don't call it a store of value. I understand some of the uses, but how can it be a store of value when it can move 50% in 2 months? That's not in fact, that's why countries are using cryptocurrencies because their own currencies are moving to that degree. This is a way to either transfer money and you don't want other parties to know, or a way of getting money out of your country in governments, authoritarian regimes that don't want you to take the money out, right? So if you're in Venezuela and you want to get your wealth out, they're not going to let you take it out. So you put it in crypto. If you're in China, you used to be able to buy real estate in California. Now they don't let you transfer more than $50,000. Well, we'll see. And they just buy the crypto and transfer it that way. What happens when the government comes out with their own digital currency? China will come out with a digital central bank digital currency next February before the Winter Olympics. Europe will follow that. The U.S. will follow that. What happens when you have a U.S. central bank digital currency to be able to transfer money? And there you got the backing of the United States, as opposed to I've got blockchain, which means I've got a lot of people looking at it that can verify that it's there, but no value. Yes.
How will artificial diamonds affect the price of real diamonds?
Yeah, I don't know, but I would think it would bring the prices down. Although I understand zirconium, you can spend a lot of money on it really good, but these are flawless diamonds. You can actually put flaws in it if you want. It's weird how they can, but yeah, it's disruptive, right? That's what technology does. It brings prices down. It's deflationary, it's not inflationary. So you take demographics in the US plus technology, it's hard for me to buy into this long-term upward phase in inflation. We're going to get a spike, it'll come down, it'll be higher than it was, but I don't believe it'll be problematic. Yes?
Okay.
Yeah.
So we passed the recent infrastructure bill, and now we have the Build Back Better, more social service infrastructure bill, even a bigger number. The likelihood of that passing at that big number, or had been brought down, but still in a number. And then what does that mean in terms of good places to invest if that social service infrastructure bill passes? And are you concerned about the debt limit in December? Are they going to work that out in time?
I used to not worry about politics at all. Now I've had to incorporate it in my decision-making process because it makes a difference. I'd love to think that they would do the right thing all the time, but now one party feels their job is to make the other party fail, and vice versa. I mean, it's not one good, one bad. That's our mission is, and so I'm not that confident, but I do think I think it'll pass. I think some of the things that were done for the infrastructure that brought the 13 votes from the Republicans, I think there'll be some agreement, get the debt limit passed. So I'm not worried about that. I just worry about the discourse keeping things that we need from actually materializing. And that gets back to some of the social aspects. I mean, the progressives kind of got crushed in this, didn't they? They got kind of back away. This is not what America wants right now. That was in that package, and it got taken out. So
Eventually,
I do think it'll pass. I think it'll add 0.25% to GDP a year, is what the estimates are. So that's still pretty good. We'll take what we can get. We want the economy improving. Yeah.
I know a lot of us in this room are probably invested in real estate and love to hear some predictions about residential, commercial real estate, and along with the REITs.
Wow. I used to work for Sam Zell, structured real estate deals for him before I went to work at Morgan Stanley. If you're not familiar with Sam, he sold his REIT for $36 billion, I think, in 2006, 6 months before the top of the market. Brilliant guy. Loved working for him. So I think I know a little bit about the real estate market. What's great about the real estate market, the residential, is the millennials, as a demographic group, is larger than the baby boomers. And they are right at that 30s and 40s. So demand for residential property is greater than what's being built right now. I haven't looked recently to see if they're building more than 1 million units, but the demand's for like 1.5 million, and I know we're not there yet. And so that's got a long runway. I think it'll do real well, and the real estate stocks are doing really well. The infrastructure stocks, they've already had their move. You're kind of late. And a lot of that's already priced. That's the problem with, you hear about it, you wait too long. Smart money moves when things are less bad and less good. Retail money usually waits till things to get good or they're bad before they buy and sell, and it's all about the rate of change. But yeah, I like the demographics. Plus, you say, well, they don't really have the money. Well, thank goodness mom and dad is writing a lot of checks right now and help financing those. And I know this firsthand because of what's happening to millennials. My daughter didn't get married until she was 33. And I could tell you after their dance, I know what she wanted to do. She wanted to go back and make a baby. I mean, I'm married, I want a baby, and start the family. That's why I'm down here instead of in Annapolis, because it happened on their honeymoons. But anyway, but you can just see what happens. And then it would be start a family, buy a home, buy stuff for the home. And that's a big driver. And the money's there. But as you know, the markets are tight because prices are up. So certain people are getting priced out. And what looks expensive here, I live, as I said, in Ponte Vedra, and people go, God, look how expensive it is. Well, not to somebody from Jersey or Connecticut. It's cheap. Naples is expensive. So commercial is interesting too. You wouldn't think there'd be much demand for that, but the leading indicator for me is something called the Architectural Billing Index. There's a high correlation between that index rising and new properties being built, and that index has actually been rising, so that does suggest that there's some increased demand. What's also happening in office is, and I know a company that's doing this, they did what Airbnb does, but now they do it for warehousing, and they're using office buildings as warehousing units now because a lot of them have the elevators. So you know what? You don't have anybody in your building. We'll just warehouse it, and now they've got a national list. So now you're a manufacturer, and you want a destination point in Ohio before you deliver it to your end user. You may end up parking it in an office building, your space. So it's finding multi-use. You're seeing malls becoming part hospitals, emergency care, because you've got parking. You've got the big anchor that has the great entryway, which is perfect if you want to have that as your emergency room. So they're coming up with new uses, but still retail can't be that great. Warehousing is going to be big, and office is going to change because the work dynamic is changing, right? We're not going to have as many people back to work, and I see it in our industry. So it's a little trickier, but I do like residential a lot. Yes, sir. Yeah.
Let me just ask a quick question. You and I talked about this last night. The old 60-40, 65-35 asset allocation model, that's not what it used to be. You want to weigh in on that?
Yeah, most diversified portfolios preach a combination of 60% equities, 40% bonds. And if you look at over history, it's done really well because interest rates have been declining for 30 years. You've been in a bull market in bonds. And the 60, 40, 10, 15 years ago, well, you made 6 or 7% on your bond side. So it offset equity risk and gave you a decent return. But bonds are paying 1%, 2%, 3% now. It's also been more volatile. There's something called a risk-adjusted return. You take the return over the volatility. Bonds are the second worst performing asset class the last 3 years. The only thing worse has been commodities. So you have to rethink, if I have an equity portfolio and I want to reduce that risk, I don't believe that fixed income is the way to go. I've told my team of 10 that manage not just my money portfolio, but clients in the traditional sense, to start looking at alternatives, whether it's a real estate transaction, equipment lease, triple lease if you want something conservative, private equity, in tech. There's all kinds of diversifiers that can pay a yield that's greater than what you can get in bonds. And I would really look in that direction, because I think fixed income is going to disappoint going forward, because I think rates are going to drift higher. And the other thing is, I get on I've got an analyst, a 15-year Greystone analyst. Not that means anything to you guys, but those that are familiar, they're kind of an elite group at our firm. Most people look backwards at performance to pick somebody. Again, it gets back to that patterns, and we're linear. So think about anybody that's done well the last 1, 3, 5, and 7 did so in a falling interest rate, falling inflation, excess liquidity be injected in the marketplace. Those days are gone. We're likely to have the exact opposite of that. So whoever did well the last 1, 3, and 5 have a really good chance of underperforming the next 1, 3, and 5, because their approach, if it's fixed, is swimming upstream for a while instead of downstream. So I would rethink what you have in your portfolio. Yes, yeah, great.
Rick, good seeing you again. Back in the 80s, my mentor taught me, watch which way the government is leaning and lean with them. I think that could never be more true than today. And in looking at electrification of the United States, a Tesla uses 4 times the copper of a traditional car, and all of the panels are made of aluminum. I think it was Minerals Company that said beginning next year they may have to begin rationing aluminum. And there was a permit request made by Rio Tinto and BH Pilotin for a copper mine to be built out west, and it was denied by the administration. It looks reminiscent to what caused the price of coal to go up 150% in the past 12 months. So what do you think about commodities broadly and the metals in particular?
Commodities have been basing for 15 years. They've broken out in the last year. They look like there's more upside to that. And it's not just the demand side. There hasn't been very much in the way of investment. So the supply has really shrunk. So yeah, if you go to Chile, they haven't invested in their mines in 5 years. Well, now the demand picks up a little bit, and boy, that just shoots up the price. So if you want an inflation hedge, I think commodities make a lot of sense. But you've got to watch China, because China sets the price for commodities. They're the key player. And China's slowing right now, and maybe slowing for another year or two. So you may have to be patient for these little spikes, and then all of a sudden you see it roll off again. But you can't have a commodity bull market without China. Great. I appreciate your time. I hope it made sense to you.
Thank you very much, Richard.
Thank you. Good to see you, Mike.